Gold, believe it or not, if you go look at January 1st, 2022, it's outperformed the Dow, it's outperformed the NASDAQ, and it outperformed the bond market by a lot. And while I don't think it has as much pace to go higher as fast as we managed in these last few years. My target from when it was 1,300 was 2,500. I think 2,500 is very reasonable. And if some of these things that are starting to occur now and the cracks that we're seeing geopolitically, uh, monetarily wise, and of course, social and political, then I could start looking at a much higher number.
Peter Grandich forecasts a target price of $2,500 for gold, attributing it to recent geopolitical, monetary, and social developments. The resurgence of gold mining shares signals a strengthening bull market, especially after a prolonged bearish period. Gold futures surged to record levels, surpassing $2,200 per ounce and reaching an impressive $2,233 per ounce. Market sentiment suggests major central banks might initiate an interest rate cut cycle, attracting buyers to gold. Despite skepticism from some financial advisors, investors are gaining confidence in gold amid expectations of 3 rate cuts from the U.S. Federal Reserve. Grandich highlights the significant role of geopolitical dynamics, such as the rise of BRICS nations and their divergence from the U.S., in shaping the gold market's trajectory. In 2023, gold soared to unprecedented levels due to global financial uncertainties and geopolitical tensions. However, interest rate hikes by the U.S. Federal Reserve increased the allure of interest-bearing assets, tempering gold's appeal. Grandich notes central banks' substantial accumulation of physical gold as a bullish factor. David URL, editor of Junior Miner Junkie, underscores central bank buying as a critical factor driving gold momentum. He suggests that a monthly or quarterly close above $2,100 could trigger a substantial advance in 2024, potentially reaching an initial target of $2,500. Join us as we explore the valuable insights provided by Peter Grandich. Don't miss out on our latest updates, subscribe to our channel, and activate notifications. Thank you for tuning in.
I made a very, peculiar decision in the end of 2021. I felt, and I said it was just for me. I didn't, our planning group people weren't encouraged to follow it exactly or even close as I did. But I felt that gold was going to outperform stocks and bonds for at least the next 3 years. So 22, 23, and 24. And I didn't want to own any equities or bonds other than things that were related to natural resources. And gold, believe it or not, if you go look at January 1st, 2022, it's outperformed the Dow, it's outperformed the NASDAQ, and it outperformed the bond market by a lot. And while I don't think it has as much pace to go higher as fast as we managed in these last few years, my target from when it was 1,300 was 2,500. I think 2,500 is very reasonable. And if some of these things that are starting to occur now and the cracks that we're seeing geopolitically, uh, monetarily wise, and of course, social and political, then I could start looking at a much higher number. But at 2,500, not only will we have made a lot of money from where we bought it, but I think finally the things related to it, and particularly mining shares, which had an horrific bear market, and I had my head handed to me. So I put on my pant legs one leg at a time like everybody else. But even now, we're seeing that turn now beginning. We actually saw in the last couple of days gold shares outperforming, even though gold was up, gold shares went up even more. And that real bear market, as bad as it was, actually set up for a much stronger bull market because how bad it was. Because basically everybody that needed or had to be washed out got washed out. So there shouldn't be much overhang in that market now when we start to make higher highs. I think the biggest role is the standout that we all are aware of, and we've been aware for some time, and that is the huge acquiring of physical gold by central banks.
Yep.
I think another thing that's important, and as much it was a pain to watch, because many of us are given like the COMEX, I think the changing of where the physical market is being centered now has been a critical bullish development for gold. The London, New York markets just don't have the influence on the gold market that they once did. And Asia, as each day goes by, becomes more and more of a player there. And therefore, finally true physical demand is playing a bigger role in the actual gold price than the paper market, because it wasn't too long ago, those I remember, let's say in the 2000, after the peak in 11 through 16 and 17, when we would have a 30 or $50 down day on the gold COMEX, Crimex, and it would take weeks or months to make up that loss. Now it's made up in hours, no longer than more than a few days. So it's clear that the paper market doesn't have the same negative impact that it once had. I think that's second to the fact that the physical market is so in demand because of central banks. And I do think that there's people that are buying it, but I also think that there's people buying it quietly, not so much in North America, but around the world because of geopolitical concerns. I think it's a big mistake. I don't think 10% of financial advisors in the US, that's all I can speak to. I don't talk to really any outside the US. I don't think any of them could ever really pass any strong geopolitical test right now. They certainly scoff at the idea of the BRICS, and I say to them, hold on, folks. Here's the simplest thing. No matter how big it gets, those countries used to deal with the United States. Now they purposely don't want to deal with the United States. How does that benefit the United States? And they always go, what time's lunch, guys? And,
Yeah, normalcy bias.
yeah, yeah. So I think there's also a geopolitical factor in the gold price that has been positive.
Grandich suggests that despite long-standing predictions of lofty silver prices, such as $50 or $100 per ounce, those forecasts have not come to fruition. He advocates for a more pragmatic approach, focusing on achievable milestones, like reaching $30 per ounce. In 2020, the silver price surged above $20 per ounce for the first time in 4 years and has since remained above that level, peaking at $29.59. Although it repeatedly tested the high $20s, including surpassing the $26 mark again in November 2023. While silver has not yet broken through the $30 mark, Keith Neume, CEO of First Majestic Silver, believes the white metal could climb even higher, eventually reaching triple digits. On Thursday, March 28, 2024, the price of silver opened at $24.75 per ounce, up 1.19% from the previous day's price and up 3.45% since the beginning of the year. Let's return to the interview.
In my days of speaking at the gold conferences around the world, the silver bugs always got mad at me because I always called it a second-class citizen. It's improved because its industrial demand has improved, but it's still not at viewed by the key people yet as the same as gold. So I think it's going to take not only gold going up, but a clear movement of the public and institutional sector coming to this market that talked about 50, 100, $200 silver. I've heard that for decades. And my answer to when clients and friends ask me about it, I say, let's get to $30 first. Then let's start talking about those numbers. I want you to buy gold and hope it doesn't go up. And somebody will look at me, Mr. Grandich, why would you want me to buy something if you're hoping it doesn't go up? Because what little you're going to buy, if it goes up a lot, I can tell you what mostly you have is going to go down. Okay. And so you're right. Gold should always have been, and still for most, just an insurance policy. Just like we have car insurance, we have home insurance. Most of us don't want our cars or homes to burn, but if they do, we want something to offset it. But I think gold also became, and why I got so involved in it and felt that in 2022 you could actually own it as an investment past just insurance, is because there's such bullish scenario for it. The inevitable currency implosions occur. One thing history has taught us: no currencies ever last forever or close to ever. But gold somehow has managed to last for thousands of years. Now, central banks are not buying Bitcoin. This is why I keep saying to them, they're not. Now, you could have financial guys that are trying to create a market for it because they want to make money selling it. But wanting to make money selling it versus basing your whole system on it is not coming close. In fact, most major countries are going to implement digital currencies. And with digital currencies especially, Bitcoin is not an ally to governments because next door with apple pie and a flag, but it's still a place where a lot of people use it to do underhanded things and also keep from reporting to governments and all. And to try to overnight legitimize it versus something that for a few thousand years has worked and always has protected, and now you want to attack. That's what irked me so much about this Fink comments. Something that's proven to be stable and all, and he's supposed to be the world leader of a major financial institution.
Grandich suggests that despite long-standing predictions of lofty silver prices, such as $50 or $100 per ounce, those forecasts have not come to fruition. He advocates for a more pragmatic approach, focusing on achievable milestones like reaching $30 per ounce. In 2020, the silver price surged above $20 per ounce for the first time in 4 years and has since remained above that level, peaking at $29.59, although it repeatedly tested the high $20s, including surpassing the $26 mark again in November 2023. While silver has not yet broken through the $30 mark, Keith Noom, CEO of First Majestic Silver, believes the white metal could climb even higher, eventually reaching triple digits. On Thursday, March 28, 2024, the price of silver opened at $24.75 per ounce, up 1.19% from the previous day's price and up 3.45% since the beginning of the year. Let's return to the interview.